Shanti Ekambaram now joins us from Kotak Bank. Ma'am, Pankaj here. I just wanted to start by asking about the Q3 profitability that we have seen, the aggregate results. They have been very, very low. Estimates were also low. How do you see that with regards to the optimism that we have?
So the Q3 results are clearly showing that growth is yet not back with the bank. Earnings are still muted, which means what's happening in terms of activity in the underlying economy is still sluggish. So what we saw, beginning last May as optimism and, positive sentiment is good. But what's not happening is investment is really not happening in the ground. So I think corporate earnings are really reflecting that earnings growth is still sluggish, which means from a actual business on the ground perspective, growth is still, or fast growth or higher growth is still elusive. I think companies are continuing to focus on efficiencies, on trying to see how they can, ensure that profitability is attained. But we are not yet seeing the investment cycle kick in. You can see that across sectors, and that's what it's telling you. So as usual, fundamentals are changing very slowly. Technicals, which is the market, has gone way ahead of fundamentals. I think the Q3 results are just really, sort of embodying that fact.
Right. Most of the management that we have spoke to from the large cap space after the results said that Q4, Q1 will also be sluggish. Do you expect a pickup in the economy, pickup in the numbers to be slightly delayed than what is currently predicted?
I think so. I would concur with them that it is possible that growth may start really taking shape by August, September this year. I think right now everybody is focusing on saying, will we get a pro-growth oriented budget? Will there be a rate cut after the budget? What's happening in the global markets? I think there are various variables right now. But one is not seeing that Q4 and Q1 is going to exhibit a very sharp increase in growth. I think, yes, it has been stable as compared to a decline in the past few years. But you're not yet seeing the uptick, as one would expect. So it's possible that Q4 and Q1 are also chugging along and more sluggish than what is expected. And you may see maybe from July, August, the growth pick up.
Right. One would say that the investment or the confidence of private sector towards investment is still very low, despite the sort of changes that we've had. How does one address that? How does one come over that fear that the private space has for investment?
See, you have to divide this into 2-3 parts. If you look at really the core sector, whether you take cement, steel, power, etc., we still have a lot of capacity utilization left. So there are, almost 25-30% of capacities yet to be utilized. Second, many companies have projects that are still stuck. I mean, you have projects in, gas-based projects where the plants are ready, but there is no gas. So there is some unlocking of activity and churn in the infrastructure sector. Third, if you look at where do we need most investments now, we need investments in the infrastructure sector. And really, I think government has to lead the way in kickstarting and pump priming the infrastructure investments. I think private sector is going much slow because there are many things that are still stuck. Some of the policies are just panning out, as you can see the coal block allocations that are currently on. So I think it is taking time, and what I am hoping from the budget that the government will do is maybe allocate some amount for pump priming investment and growth through some allocation for infrastructure expenditure. So I think government has to lead the way, private sector will follow, but there are two factors that we have to consider. A, in some of the core sectors, there is still capacity existing. B, there is a global glut, and that's why you've seen the commodity prices fall. And there is a real fear of dumping, in which case you're not going to get the investment cycle up in a hurry.
Right. From the budget, would just like to take that conversation ahead. More spending towards projects, towards capex, towards trying to sort out infrastructure issues. Would that be taken in positively by the investors?
Most definitely. See, if you look at the backdrop of this budget, they have a very favorable macro factor. Oil is almost half in terms of prices, right? So there is a huge ability to divert some of the subsidies that was taken up in the budget towards pro-growth or towards investment in infrastructure or pump priming some other way. Second, there is a cess and excise that they have on petrol and diesel, which can be used for investment in infrastructure. Having said that, the budget is still going to be a tightrope walk because the market, the central bank, and global rating agencies are expecting fiscal prudence, and we've heard the finance minister say that. So 3.6% was what was projected in last year's budget, and the finance minister said that he would try and abide by that. So assuming that fiscal prudence is here to stay, there is a reasonable amount of tightness within which the budget has to be operated as to how much they can allocate for expenditure. Two critical things. A, direct benefit transfers, which hopefully can reduce the amount of subsidies through leakages. And second, actually, some of the subsidy that would be freed up on account of oil can be diverted to expenditure. So in my mind, it is going to be a tightrope walk, but one is expecting some pro-growth initiatives. One is expecting some initiatives to boost this Make in India in terms of fiscal initiatives. One is expecting some tax kind of initiatives for investment in maybe REITs, infrastructure bonds, etc. So one is hoping for a growth-oriented budget and how you can pump prime investments, and that would certainly be viewed positively by investors.
Right. Infrastructure and manufacturing would be one space. Do you think that will also focus on the employment generation that they have been largely the new government has been talking about?
Yeah, I think you need the investment first, and then the employment gets generated. That's still, I think, a medium to long-term plan. I think what is also important is the government lays down the vision for the next 3 to 4 years through the budget as to how they see the whole, economy and fiscal situation panning out. But most certainly, we need the investments for creation of jobs. You need the manufacturing, Make in India, the whole campaign for creation of jobs. And I think that's a critical aspect.
Right. We've also heard the FM earlier saying that, the sort of leeway or the sort of room that he has looking at the tax growth is very, very low. So do you think that a lot of tax sops is something which is out of question, or something unreasonable to expect?
I mentioned earlier that this is a reasonably tightrope budget, because if you have to sort of meet the fiscal deficit targets which has been laid out, I think the ability to give sops in every area is limited. Second, one would wish that there could be more money be put in hand of individuals, say by tax cuts, but that would again fuel a consumption-led growth. Right now, what Indian economy needs is an investment-led growth, and my own perspective is that given the limited room that they have, I would rather that they spend on incentives and fiscal incentives that would drive investment more than drive consumption. So I think the room for deep tax cuts or large tax reforms is limited. Having said that, things like GAR, etc., can be put back indefinitely at a certain period of time, which would also be a positive sentiment as far as the market is concerned.
Right. Let's shift focus from the budget to the rates in the system. We've had a rate cut of 25 basis points. Expectations have increased after the new GDP, the new CPI series have come out. Do you think just changing the series will lead to further rate cuts? I mean, that's the buzz on the street, that after the new CPI, CPI overall percentage might be lower than what was earlier predicted, and rate cuts are likely to come in faster than expected.
See, if you look at the whole construct, I can't say that I understand the new construct of the CPI or the new GDP entirely. But if you look at it, the theme is that CPI seems to have come down. There are two key reasons for it. A, there has been a sharp deflationary downward spiral because of oil. Second, prices of fruits and vegetables have come down. So if you look at it, in my mind, if the budget contains the fiscal prudence that is talked about, I expect a rate cut post the budget or latest in the April policy. My sense is thereafter, as India always expects, there is a monsoon that will come to bear. To say that what is likely to happen in the monsoon, if the monsoons are normal, then you can expect some more rate cuts. But if the monsoons are not, then again there is inflationary. So my sense is, if I look at just the near term, I do expect a rate cut after the budget, depending upon what the budget contains, no later than the April policy. Another 25 basis points.
Right. Rates in India are very high when you compare it to the global global markets, some of the other emerging markets as well. Do you think that sharper than expected rate cuts will also see a very fast improvement in investments?
See, it could have a small role to play in investment, but that is not the only reason why investments come. Yeah. So there are two things. I think the central bank governor has very clearly said the rate cuts will be triggered by factual data. So as and when you see data roll out through the entire fiscal year, you will see rate cuts pan or not pan. In my mind, the confidence, the ease of doing business, clarity on taxation, ease of acquiring land and approvals for business, in my mind, is as big a component and perhaps a more driver of component for investments than just the rate cut. Rate cut is just one of the triggers. But I think the ease of doing business and all that goes towards setting up capacities, manufacturing, etc., is very critical for triggering investments.
Right. One aspect that a lot of other bankers also have been pointing out is the retail banking and the growth that the sector, especially the private banks, are seeing over there. Do you see a radical shift as far as savings in the retail is concerned? That in turn can lead to a lot of liquidity easing in the system?
See, if rates come down, you're going to find savers wanting to say, how do I get a better return? Yeah. So you've seen accretion to the deposits in the system over the last several years. This last 12 months, you have seen a lot of money move into, equity mutual funds by way of SIPs, where, people are seeking more sort of return. The good part is perhaps some amount of diversion from real estate and gold has come back into savings in the form of, equities, in the form of deposits, etc. So if there is a sharp cut in rates, you might actually see savings seeking higher returns. Savers may become investors. So one is waiting and watching to see how the trend goes. But certainly there has been some improvement in the savings, like I said, some diversion of funds from gold and real estate. But wait and watch how the rate scenario pans out.
Right, ma'am. Just before we conclude, you started by saying that fundamentals or other markets seem to have run ahead of how things are changing on the ground. Where do you expect in terms of markets? You expect flows to continue to be strong, both from DIIs and FIIs into India, in expectation of very high growth going ahead?
See, like I said, right now you're still seeing growth sluggish. You have seen an enormous amount of funds that have been pumped into India in the last maybe 9 months or so, right? There are global events happening right now that can also shape the flow of funds in addition to local events. You know that there is an event happening in Eurozone, you don't know where Greek is going to go. But I think the bigger picture that one needs to watch out is what is going to happen in the US. From all indications of data in the US, the chances that there could be an interest rate hike in June, July seems to be much higher. Earlier, it was expected to be September, October. I think the rate hike in US can have a significant impact on flow. There will be capital flow back into the US. To that extent, I expect volatility in the flows into India. See, India is a medium to long-term story, which is very good. So you could continue to see a lot of money flowing into India. But global events will really determine the volatility in the flows. As far as local event is concerned, people now would want hard evidence of investments and growth panning out. I think a lot of funds have come into sentiment, India macro stability, India currency stability, and a whole host of that. From now on, people would like to see that the story is indeed panning out. So I think investment is a medium to long-term story. Medium to long-term, you should expect strong flows coming into India. In the short term, global factors could trigger some volatility combined with how the local growth plans are.
Right, ma'am. Thank you so much for joining us here this morning.